You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysis.radio.com.
All right, everybody, we are back on the podcast, and my next guest needs no introduction. Ari Wald is the head of technical analysis at Oppenheimer. Ari, thank you for being here again.
Thanks for having me back, JC. Really appreciate it.
We don't have a lot of repeats on this podcast. You're one of the few, and a big reason why I want to make sure that you're back and back again, hopefully in the future soon, is really because I have just such a ton of respect for your work, your top-down approach to the markets, the buy-side managers that you're talking to. I really do think you bring a unique perspective. So if you guys listening out there are curious a little bit more about Ari's background, go back to season 1 and listen to that podcast. This episode, we're just going to dive right into it. Ari, today is August the 6th of 2019, and volatility has picked up over the last week. I'm just going to open it up to you. What do you see? And talk to me.
Yeah, JC. Mark, I mean, what a change in the market sentiment, probably if we were having this conversation today versus last week. And what we pride ourselves on is really that type of volatility doesn't sway us much, or we like to take a step back and unemotionally give our view and not just get swayed by the ebbs and flows of the market week to week. So our take here with the S&P 500 at 2861, down roughly 5% from its all-time peak set just last month. We've retraced 23% of the advance since December. I view that, and how I've been taught, is that's a minimum retracement, that is still considered a minor pullback versus the strength that we saw going into it. It's within trend, still above a lot of the key important moving averages, like its 200-day moving average. So how we see it, it's less so the similarities to the volatility and the initial pullback that we saw in October of last year. And we think more similar, and the roadmap we're following is closer to what we saw in 2016. That following a reset in the market, that December 2018, much like February of 2016, marked what we would call a small bear market. And this we've seen strength since then, and hasn't quite been able to definitively push out to the upside. And there's some missing confirmation, most notably in small caps. But we still think that this is just a shakeout like the summer of 2016, ahead of what we think is going to be a new upcycle in the equity market.
Ari, in your role at Oppenheimer, are you equities focused only, or does your role expand to, I know you do a lot of intermarket analysis, of course, but is that just for your equities work, or do you opine on the commodities market and Forex and things like that?
I look at it all, JC, but our clients are institutional money managers that are focused on equity selection and equities at the end of the day. We're stock pickers. So we'll have views on commodities and currencies and all the different intermarkets. Generally, it's going to influence our stock calls. So I'll have views on that, and I'll look at everything. But at the end of the day, clients want to know from us two things. One, what the market is doing. At the end of the day, still being a market strategist, and the importance of getting the market call right. I think that is what I'm getting judged on. And then on top of that is, okay, what stocks do I buy? What sectors do I overweight? We also put a lot of emphasis on the bottom-up selection process, our methodology being ingrained in the momentum factor. We often say that we are momentum investors that overlay technical analysis onto our process. So to answer your question, for the most part, yes, we are U.S. equity focused.
You mentioned small caps briefly there, and the underperformance that we've seen. You've done the math, I've done the math, we've seen the charts a million times. Throughout American history, we have seen periods of time where the small caps are just laggards, most recently in the late 90s, where you could take it back to post-World War II, take it back to the 1980s. We saw prolonged periods of time where small caps underperform. So the market, the large caps, S&P and the Dow can do well even with small caps underperforming. But correct me if I'm wrong, they need to at least participate, and they really haven't, right? So where do you stand on this small cap divergence?
That's exactly correct. How you framed it there. It's more important for small caps to participate in absolute terms rather than lead relatively. We could look at actually big secular bull markets, specifically from 1946 to 1964, and then again from 1983 to 1999, that were led by large cap stocks. So to see large caps outperform is consistent with a rising market, but we do indeed need to see stocks participate across the board, across capitalizations, and small caps have to participate as well. That often one sign of a market top is your classic internal breadth divergence, where small caps start to break down ahead of large caps, and it gets masked in the cap-weighted indexes. You don't necessarily pick it up, and for that reason, it can be considered a concern that the Russell 2000 gauge of small cap stocks has been limited to below. It hasn't made a higher high. The key level I'm watching is 1600 on the Russell 2000. The index has been below there really since last October. We've seen some weakness more recently in small caps, as now they're moving to the lower end of the range. I guess as it stands, this is still a concern. It's lacking confirmation. I still think the case can be made that simply additional time is required, that it hasn't necessarily been a breakdown just yet, that after that climactic low for the Russell 2000 in December, it's really been more abiding its time, working sideways, and the next direction has yet to be decided. Another way to look at that is with the value line geometric average, which is an equally weighted gauge of 1,700 stocks. Looks similar to the Russell 2000. Hasn't made a new high since September. It's been making lower highs indeed, and showing some weakness again more recently. But if you were to take that index and really take a step back, this value line geometric had a very important breakout in 2017. It moved above 20-year resistance dating back to the year 1998. And so if you were to look at a 25-year chart of that value line geometric, what you'll see here is a major 20-year breakout, and now this index has come back and it's testing its prior breakout point. That often former resistance becomes support. So from that lens, it can be simply, the case can be made that the average stock internal breadth is, yes, while stabilizing, but this is actually the point where participation should actually start to broaden rather than weaken.
So let me give you a little pushback then. You can't just agree all the time. That's no fun. So 20 years of nothing in the value line geometric, right? Right around, let's just call it 500 and change as that overhead supply since the late 90s. We broke out, or at least tried to. So what if, what if a month from now or a few weeks from now, we're sitting here and the value line geometric index is well below 500, let's call it 460, 480, and just holding down there? How do we take that?
Well, this is where the importance of portfolio positioning comes into play, and being properly positioned for all scenarios, both bullish and bearish scenarios. If that scenario were to play out, often the weak get weaker. We always think in terms of how the market ranks in our momentum ranks. That for the most part, we want to be positioned in the top quintile of stocks in terms of ranked momentum. That typically stocks, and when we speak about momentum, it's loosely based on 12-month performance. Stocks that have been the outperformers over the last year are usually stocks that continue to outperform. And conversely, it's the low momentum stocks, the bottom quintile, that are often at risk to get weaker when those bearish scenarios play out. So if I'm long U.S. over world, and here's, in summary, here are our themes: U.S. over world, big over small, growth over value. And let's speak in terms of big over small, because that's really the kind of the comp that we're the theme that we're talking about here. I don't want to be in small caps right now. That's why our conviction is more on the large cap side, because in that scenario where the value line starts to break down here, I think you're going to be at greater risk to be in those smaller cap stocks, and I think you can outperform in that backdrop, being more heavily invested in large caps. Now, if that were to play out and you start to see large caps start to break down as well, you'd have to start cutting back your exposure to that theme as well. That's down the line. It's something to watch and something to prepare for, and it would hurt your overall equity allocation. But I think for the time being, given these non-confirmations, for all these reasons we've just explained, this is why you don't want to be in small caps. If you are bearish for those reasons, I mean, first thing you want to sell is what's causing the divergence, which is small cap stocks.
Well, Ari, so if you take a step back and you look at the Russell 2000 or the small cap 600 or one of these small cap index, you look at the transports, they look exactly the same, right? The Dow Jones Transportation Average. So it's not just the small caps underperforming, but you're seeing underperformance out of the large cap transports.
That's right. And there's another great example of a market that doesn't have to lead in an upward tape. In fact, if you kind of look back historically, when small transports have underperformed, you see that they'll often underperform during big parts of a secular bull market. They peaked on a relative basis in 1989 and underperformed throughout the 1990s bull market. They peaked back in 1953, which marked the middle innings of the secular bull market that extended into the 1960s. So there again, bears want to make a lot of underperformance by a cyclical group, whatever it might be, whether it's banks, whether it's transports, whether it's small caps, whether it's semis. At the end of the day, they need to participate in absolute terms. Why there's such a big emphasis on transports? It gets back to good old Dow theory that that gets quoted and often misused as well. Now, Dow theory, the media pundits, they want to use it as a trading signal. They want to make the call, transports were weak last week, and that's bearish for the overall market. When in fact, Dow theory is not a trading signal. It is used as a signal for the market's primary trend, bull or bear market. So from that lens, transports did indeed break down. They broke down back in the fourth quarter, and it confirmed a breakdown in the industrials. We've been on a sell signal since December. Nothing has changed since then. It's still a sell signal. So from that lens, if you were to view the market as a bear market since December, and you still view it that way, to move it back to a buy signal, the transports, how I count it, have to make a close above their April high at 11,099. So something we're watching for. I guess my take is that I really just see some sloppy, trendless action in the transports. Again, another market index that's really just been in a range for the transports. It's between 9750 and about 11,000 on the upside here. So again, I could make the case that really just taking its time, but I want to be prepared for what could be a move to the upside after such a prolonged downturn in this key market average.
And not just from an underperformance standpoint, but just the way the charts look. They look exactly like the small caps and mid caps.
They do have a similar view. I think what's a key message that we're seeing is that risk has been in decline really since the first quarter of 2018. I mean, here, even the S&P 500, now with this decline back to where it first traded in January 2018. That's 18 months of no market progress. That's the bear market, how we see it. We think we're getting towards peak safety rather than peak risk here. You see it in world equity markets as well, whether you're looking at the MSCI all country world indexes, Europe as a whole. They all peaked at some point, whether in late 2017, early 2018. They all made meaningful lows in December of 2018. And after that year-long decline are actually now starting to stabilize to a certain degree, once again correcting of late. But how I see it, a lot of those equity markets are in a better position now than they were the summer of last year, when they were breaking down from more distributive topping patterns. Now what we see is really just some ugly base building in those markets. Again, more work is needed, and it puts our focus more on the leadership, which is in the U.S., and why we're recommending U.S. over world. But again, from that viewpoint, if you're worried about that the divergences that are developing, we think the weak get weaker. It's why you don't want to be in those lagging indexes, whether it's the European indexes, whether it's transports, whether it's small caps.
Well, let's stick with that safety, that sort of risk-off sort of mentality that you mentioned. Yen making new highs, gold making new highs, treasury bonds making new highs. To me, correct me if I'm wrong, I look at these as the flight to safety assets. So with all of these making new highs, what do we know about new highs? We know it's not evidence of a downtrend. So with all of these safe haven assets acting so strong, what does that suggest to you about risk appetite or risk aversion towards equities moving forward? Or do you think that was it?
Well, what I think you've just described there is a trend that's been in place for much of the last year that I think, for a proxy for that safety trade, look no farther than the 10-year U.S. Treasury yield. And it has been that move from 3% late in the third quarter of last year to now 1.7%. That has coincided with a lot of that risk-off action, utilities outperforming, REITs outperforming, consumer staples, the more counter-cyclical and defensive areas of the market that act as bond proxies. I guess my take is that trade is getting a bit extended and crowded. And I think for all those reasons, I want to be open towards what could be this rotation towards cyclicals that could help propel that next leg of the uptrend. Now, it's one thing having that firepower, and the other hand actually seeing it. For me, it's both the direction and level of interest rates that are very important. Right now, they're deeply oversold. That's a good thing, but they're still moving lower, which is the bad thing. And until that trend changes, you're going to continue to see a lot of these, risk-off themes continue to do well in the market. For me, then you start to have to ask the question, why are rates as low as they are? And look no further than the action in overseas bond markets and the lower rates and near zero rates and negative rates in the Eurozone and Asia. So I think with that backdrop, that gets into our preference for growth over value, that we have seen this premium on higher growth companies in this low growth world. That as much as the 10-year Treasury yield and interest rates have been a key driver of these sector rotations, it's rates down. Everyone's flooding to buy these safe haven sectors with high dividends like utilities. Rates start to move up. Everyone's flooding to financials and banks and more higher beta areas. But through that, technology has really been this all-weather leadership. And this gets back to why this is still such a high conviction idea for us. I think that is really the key theme linking all of our calls, that the higher exposure to technology for all these market indexes, the better the performance has been for the most part, depending on what time horizon that you're looking at. That if you're looking at U.S. overall, U.S. has been able to outperform versus world, got a higher tech exposure. Big over small. That is a call on the tech sector again. The S&P 500 isn't the defensive mega cap index that it used to be. It's dominated by these cyclical tech companies. And when I look at the technology sector, no other area of the market has shown such broad-based participation across capitalizations and across industries. And I think that's telling to us. So for what we think that is this secular bull market, and I see looking at intermarket trends in the commodity market and interest rates, I do see a lot of similarities to the 1980s and 1990s and the 50s and 60s. This is still your prime candidate to lead these gains over the coming quarters and even the coming years. And it becomes a big part of why we think the U.S. continues to outperform versus the world, why big continues to outperform versus small, and why growth should continue to outperform versus value. We see inconsistencies with this idea that one should be bearish on the market but rotate into value. That for us, we think you have to be more bullish than we are to make for the long-awaited rotation into value. That for that to happen, one needs to be making the case for more early cycle acceleration in the global economy, where you're going to have to get rates overseas higher, you're going to have to get rates in the U.S. higher. That'll cause a steeper yield curve. Banks will start to do better in that backdrop. Energy will start to do better. I'd welcome that. I just don't see it. And for all those reasons, this is why I still think technology is in a very attractive play here, that for the most part, that growth value ratio has been correlated to the yield curve. And as long as that curve continues to flatten and move towards inversion, it's already inverted, at certain parts of it, we think tech continues to outperform against that backdrop.
You know, what I find so fascinating about the tech outperformance that is you can make the argument is really just getting going. You know, tech on a relative basis did nothing for 15 years or something like that, and we are nowhere near the 2000 highs on a relative basis. So is part of your bullish thesis sort of like that the fact that we've been coming out of this massive multi-decade base in tech on a relative basis?
It's not just coming out of that base. It's how we're coming out of that base. That it's done so with very broad participation. If you look at the Russell 2000 tech sector, no issues there. That looks nothing like the actual Russell 2000, and it's done it in a very steady manner as well. That it's far from the parabolic moves that we saw in those last few years of the bubble heading into the 2000 top, that it's been a much steadier move higher. We welcome that. And for all those reasons, we think it continues. And even more recently, made another new relative high with the market in July. That's a confirmed strength to us. That's strength that usually continues rather than strength that usually reverses.
All right, Ari, I got a question for you. What about technology stocks within other sectors? So for example, healthcare is what it is, right? You got your pharma and your biotech and your managed health and all that stuff. But then you also have the medical equipment stocks. And that particular industry group looks a hell of a lot more like technology than it does healthcare. You look at the financial space, struggles McGee, right? Financials just a disaster across the board. However, you have the technology stocks within financials, like, for example, the mobile payment industry group underneath financials that looks a hell of a lot more like technology than it does financials. So how do you feel about some of these sub-industry groups within some of the underperforming sectors that are essentially tech stocks stuck in the body of a financial or a healthcare stock?
Or industrials as well. That you look at some of these industrial automation companies as well. There are tech stocks within industrials as well. And wouldn't you know that these are the stocks that have been the better performers within those sectors? So again, I think that's all telling, and I think it corroborates the view that we just laid out. And as you bring up healthcare equipment, here is a group that we recently highlighted in one of our reports, not just given how broadly strong it's been, but it's a seasonally a good seasonal play that, if you look back, August and September tends to be 2 months when healthcare equipment and services has outperformed, and it's resilient to a lot of these deflationary concerns that we're seeing. That wouldn't you know, it doesn't show up when you're looking at the price of gold, which is indeed coming off new highs, and it's done well as a safe haven asset. But the equal weighted commodity index, JC, is falling below multi-year support.
Yeah.
It's ticker CCI index on Bloomberg, the Thomson Reuters equal weighted commodity index. And if you were to look back, really a lot of those healthcare equipment stocks have been resilient to falling commodity prices. If you kind of run the correlations of how these sectors have performed against the CCI, healthcare has held up best. It's been able to outperform when commodities fall. So we think that's telling. I think you have that tailwind behind it as well. And conversely, energy stocks, not surprisingly, have been your big underperformers when commodities fall, specifically when oil falls. So I think with that in mind, you'll want to stay away from energy stocks here. Talk about kind of the opposite end of the spectrum, one sector where you've had broad-based weakness really across the board. Here's a sector that just hasn't been rewarded on when commodities move higher either. Now, we're of the view that you're going to get some dollar strength. It's going to be strong, but not too strong, and it's going to create more of a long-term commodity range, a secular non-bull market, if you will, much like how commodities traded for years at a time in the 1950s and 1960s and the 80s and 90s. Interestingly, again, making the parallels to those secular bull markets, what do stocks like high commodities, low commodities? No, the answer is stable commodities. That's what we think we have. Good for the stock market, less so for stocks tied to commodity prices. The energy sector just has not been rewarded when oil rises to the same degree it's been slammed when oil falls. West Texas crude oil, amazingly, up 110% since bottoming in 2016, up 30% since bottoming in December in 2018. Energy has underperformed against both those backdrops. If energy can't outperform when oil's rising like that, what's the backdrop? What does it need? And so for all these reasons, just given the bearish trend, the broad-based weakness, again, if you are a client that has a more skeptical view of the market, if your inputs are saying to sell here, that we're at some sort of a market top, I'm telling you, the weak get weaker. Energy is a sector that you should not own if that is the macro backdrop that you're foreseeing.
But in your case, that's not what you're foreseeing, and you think that stocks are in the midst of the post bear market, right? Because your thesis is that bear market ended at the end of last year, and we're starting, and we're 8 months into a new, or 7 months into a new cyclical bull market. That's basically where you stand.
That is where we stand. That December 2018, I think we were down 20% peak to trough. That's not what it did for us. Why we're making the case that was a bear market. That we found that the better one rule definition of a bear market low is not the 20% decline that often gets used, but instead when the S&P 500 falls to an 18-month low. We retraced even 20 months of prior performance. That was a 20-month low in December. That's a lot of time for investors not to make money. And then on top of that, when you have some of the most depleted breadth readings you've seen in a number of years, I think at the time there was only 8% of the NYSE stocks above their 200-day average, when you had the S&P's monthly RSI falling to one of its lowest levels in a decade, you had all the setup to say that was a small bear market. The S&P retraced 50% of its prior bull, which is on average, with how the bear markets look like in a secular bull market. You tend to retrace 50% of the prior advance. The only thing that was missing was duration. It was a very short decline. Speaking in terms of the S&P, really from peak to trough, it only lasted 3 months. We never got the double bottom. And so we had this V reversal where you started to move above your prior breakdown points, and I think you wanted to respect that V reversal very early on. But we were saying, well, you know what? Maybe you don't chew up the time at this lower level. Maybe you chew up the time at this upper level. So here, once again, we've been unable to hold this breakout in the S&P 500. We're back below it. I think you want to respect the seasonal headwinds that we're facing as we look into August, September, October, typically poor performing months of the year. It's keeping our near-term trading expectations in check. But, again, we still see similarities to 2016, very similar to how it traded ahead of the big run-up in 2017. And that is still the focus, our long-term view here, is that we've had the reset, and now we're due for we're within this new upcycle. When we talk about the cycle, it's the typical 4-year equity cycle, 3-year bull, 1-year bear, roughly speaking. And what's been so difficult, I think, for the more fundamentally driven investor to see is that this has all occurred within the same economic cycle that we've been in since 2009. So I do want to respect it's also within this aging economic cycle. We have had an inversion in the yield curve. So it could ultimately be the move that sets up for your final peak or into your recessionary downturn. But I still think that we're not there yet. Even speaking in terms of this inverted yield curve, we often get inquiries, should we be worried about this? And our answer is, well, yes and no. Yes, you should be worried about an inverted yield curve because every major market decline through history, they're often preceded by an inverted curve. But here's the catch, JC. The point when the curve inverts is often a very poor timing signal if you were to act on it as soon as it does. That the inversion has either been led by the peak in the S&P by over a year, meaning that the S&P could go on for another year before peaking, or two, it's lagged the peak in the New York Stock Exchange advanced decline line by over a year, meaning the weakness had already been well documented. I still, looking at the advanced decline line as my proxy for internal breadth, that's coming off a new high. So there is a case to be made that breadth isn't as weak as even the Russell 2000 is implying. That the 80 line's been a terrific leading indicator for tops in the S&P. It's peaked ahead of the S&P 11 times out of 16 major tops since 1950. So the fact that we did just recently get this new high in the 80 line still is an argument for the bull case and why we're still siding positively for the long term.
And are you referring to New York Stock Exchange AD line, S&P 500 AD? What specifically?
I'm looking at the New York Stock Exchange, common stocks only, because I have a long history of it going back to 1950, where we're able to look at how it has behaved around the tops in the S&P. And I think it's important when looking at those breadth series to key on a series that is going to include a broad mix of stocks. If you're looking just at the S&P 500 80 line or a breadth indicator based on the S&P, you're really just looking at large caps. I think it is important to look at something that's going to include not just large, but mid and small cap stocks as well.
What other breadth indicators do you look at?
I absolutely love the percentage of stocks on the New York Stock Exchange above their 200-day moving average.
Yeah.
And here's another one that hasn't confirmed the bull tape.
How do you use that?
Well, if you were to back test that indicator, what you'll find is that forward returns are above average at very low readings and at very high readings. Coming into the year, only 8% of stocks on the NYSE were above their 200-day moving average. That was the bear market low conditions that we were referring to. Now, on the flip side, what you want to see to mark the start of a new bull cycle is for that indicator to get closer to 70%. And we haven't had that. I think as it stands, it's been topping out at around 55%. With this pullback, it's back to 40%. But you really want to see those internal breadth thrusts when there's a lot of stocks moving above their 200-day and you get to a 70% reading, that type of action marked the start of new bull cycles in 1995, 2003, 2009, 2013, 2016 as well. So that is, again, we're missing it. It has not confirmed this new bull cycle, as has Dow 30 hasn't confirmed a new bull cycle. So there's still some particular divergences to monitor and to be conscious of. And for that reason, the only thing I could say is that I think it's really just a matter of time, but maybe it does put our emphasis more on the selection process and where we're positioned. And maybe this is just a market where there's haves and have-nots, and certain areas of the market perform better than others, where there's going to be bull markets in areas like technology, and there's going to be bear markets in areas like energy, and it just creates this very bifurcated mixed market for now, as how it stands.
And what's wrong with that? Right?
As long as you can identify those trends and capitalize on them, there's nothing wrong with it. But it does create, and especially if you're invested in these passive funds that are tracking a market, it kind of can, dampen performance to a certain degree when you don't have a market firing on all cylinders.
Yeah, because think about it. Some of the market capitalizations on some of these energy stocks are humongous. So if you have a diversified portfolio, you can't help but be involved in these things. And they're sort of taking away from the gains that you're seeing in your technology exposure, for example. Let's just say, Ari, that I'm a perma bear, right? And I thank the heavens every day that I am not. But let's just say that I was. And I just want to push back a little on what you're thinking. You're very optimistic. And what do you need to see to be like, you know what, guys, I really think that we need to be more defensive here. Maybe I was a little too optimistic. What do you need to see to sort of, make that turn? And number one, and then number two, on the flip side, what would you like to see to essentially confirm that you are on the right side? And we do want to be erring on the long side of U.S. equities.
Well, for final confirmation, I mean, that's the easier answer. You're looking for the breakout in small caps, and you're looking for that 200-day participation indicator to really start to explode to the upside, and you get those readings where 70% of the NYSE's above their 200-day. The next easy answer is, well, in the meantime, key on selection. If you're kind of worried about the bear scenario, well, you probably don't want to be in small cap value, which is, showing signs of turning lower, and it's, still trading at the same levels it traded at back in December of 2016, where you've made almost no market progress in coming up to 3 years. I mean, talk about a tough environment for small cap value.
Yeah.
But even with that said, let's say that you've gotten the right areas. You've been in tech, whatever it is. But yeah, sure. If tech starts to break down as well, and I love the Paul Tudor Jones line. Something falls below the 200-day. You got to get out. I think thinking about it in that terms, I like to be a little bit more flexible, and I don't think it's just really on and off. But if you do start to break down there, you have to be conscious of that. Below the 200-day, whatever it might be, I think you have to start reducing allocations and exposure to a certain degree.
Are you talking about one specific index, like the S&P 500, or maybe some of the others?
S&P 500 would be a great one because that's been one of the strongest markets in the world. I mean, it's had great exposure to technology. It's 21, 22%. It's been the reason why it's been so difficult for us to paint that bearish picture on the S&P because it has such great exposure to all these themes that we like here, most notably technology. So even from that lens, and even the NASDAQ 100 would even have that capture that even more. So even if you start to see the NASDAQ breaking down, the leaders, once they're cracking as well, the stocks that are rated high in our momentum work, the fin payment, the mobile payment stocks and the fintech names, once that cracks, there's fewer places to hide, and there's nowhere left to go.
What about the transports are below their 200-day? Small cap Russell 2000 below their 200-day. Mid caps below their 200-day. I mean, we are seeing some of that. So when you talk about reducing exposure below a 200-day, do you find yourself cherry picking some of these indexes that have much higher tech exposure, right? I'm just trying to play devil's advocate here. Are you cherry picking some of these stronger areas? How do you sort of differentiate?
Well, I love the relative ratios, and for me, it becomes a very to take the emotion up. That's why we rely so heavily on how these indexes rank in terms of their exposure to the momentum factor. That it's not so much again that that the transports are below the 200-day. It's the fact that on a relative ratio, they've been trending lower for some time and have been underperforming versus the market. So it's more the underperformance is why we're staying away. In absolute terms, I see a flat 200-day. I see more trendless action. So I guess I'm using those measures as an overall market signal, but it's not that they're below their 200-day that gives me concern. Is that the fact that they rank low in our momentum scores and that they're underperforming versus the benchmarks that we like.
All right. Listen, Ari, I'm here to give you a hard time. I'm not here to make this easy for you. I'm coming in with the tough questions. I got another one for you. So
okay.
we had a nice little shuffling of the S&P sectors because they like to make technical analysts' jobs more difficult, right? So we have this new communication sector. Google's not in tech anymore, right? But when you think about technology, Google, hello, right? So how do you, in your work, when you approach things like technology, now that things have shuffled, do you consider this communications sector as part of technology? Is it its own thing? Where does that fit in your sector rotation sort of models?
Well, that's really just, you have to go even more granular than that. And I think that's important. I think that it's been so difficult to make these broad sector calls outside of technology because there has been so many moving parts within the sector. Getting back to healthcare real quick, you brought up med devices are doing well, but that's within a sector where pharma and biotech have been absolutely underperforming and have been showing much bigger losses. So it's been much more than sector outlook. You have to really get underneath the surface. And if you look at communication services, talk about just a mixed motley crew of stocks here where you do have the internet names like the Googles and Facebooks mixed in with media companies like CBS and gaming stocks like Activision and Take-Two. And so you have this hodgepodge sector, which has some high growth characteristics given its internet exposure, and even some countercyclical high dividend exposure
AT&T.
given the telecom names in there too, the AT&Ts and Verizon. So, and that's why it's so important. So important these days. It's not only having the call of the market of the sector, but what am I buying within that as well? It becomes equally important. And I think there's some inconsistencies out there. I hear it often. It's this idea. we're bearish on the market here, but we want to overweight tech, industrials, consumer discretionary, financials, or whatever it might be. You hear pundits say that on TV, and your head wants to explode. It's like, how is that going to be possible? How is the market going to go down? But those sectors are going to outperform, but you want to rotate in there. There's inconsistencies within that. So, I think as this economic cycle has matured, you've had more uncorrelated trends at the stock level, and it's created these very divergent trends out there, and it's made the selection process all the more important. And it's, there's tougher to just kind of say, here's my view on comm services. What you really want to tell people is, here's my view on internet, here's my view on telecom, here's my view on media.
Ari, gold's making 6-year highs. The gold bugs are freaking out. They're going nuts. I'm getting phone calls from Vancouver once a week. What are we making out of this?
Yeah, and I think even the technical community, there's a certain consensus that this is setting up to be a big move in gold, and so far it has been. I've kind of already have said, like, all right, it's at the point where I don't want to bet against it, and I think that's the beauty of what we do as technical analysts is kind of say, respect the strength that we've seen and the big breakout in gold. But I think this is one where I'm a little bit more skeptical, and I see it a little bit more cynically, that I just don't see the return to that of the action that we saw last decade. I think there is an expectation that this is going to be another run like we saw from 2001 to 2011, where you had this nice steady ascent in the price of gold for a decade. I come back to my broader view on commodities, that commodity prices are going to be, that you're not going to have a weak dollar acting as that tailwind for commodities like you did last decade. That, against that big run in the price of gold, you also had a U.S. dollar index that was nearly halved, with the DXY going from a 120 level to 70. So without that backdrop, I guess I would treat it more as a trade. Keep raising your stops, trading higher indeed, bucking the trend in the rest of commodities. Here you got an equal weighted commodity index hitting new multi-year lows. You got gold hitting new multi-year highs. But I guess just not having, and thinking about, we're always trying to identify broad-based themes, right? We made the case technology is a broad-based theme. I don't think commodities is a broad-based theme. Here's the outlier. Here's the strength. Here's the leadership. Here's what's going to rank highest in our momentum work within the commodity universe. I suppose if you want to be long commodities, this is the commodity you want to own. But I do see some, headwinds from the broader commodity universe that suggests maybe it's going to be more of a trade where you get your gains in a very short amount of time, and that's just it. That you can make comparisons to, there was points in the late 1980s, 1987, where it looked like gold was breaking out to the upside, and then it just ended, yeah. and it was straight down for the rest of the 1990s. We're not there yet. Of course, you want to see some tapering off in the trend, and we've seen nothing like that yet. So again, not something I'm betting against. Raise your stops, but I guess I'm a little bit more skeptical from a very long-term perspective.
So for gold to really, for this to be it, right? This to be a massive base going back 6-7 years, whatever to 6 years, whatever you want to start. For this to be a massive base, you're in the camp that we need a weaker dollar, and you're just not seeing that weaker dollar environment through the end of the year.
I think, right, you don't have the dollar. You don't have the weak dollar tailwind, and you don't have the tailwind from just being a more broader commodity theme where all commodities are going higher. I think for that reason, I would just treat it more as a trade. It's working. Listen, but I'm just a bit more skeptical. Listen, it's of all the things I look for, rising 200 days and yada yada yada. It just broke out from a big 5-year base. I have to respect that. That's I kind of using your line. That's our job as technical analysts, is kind of take the emotion out. It's working, but
do I say that?
But I guess maybe there's some things that rank higher in terms of my conviction level for the long term.
All right, Ari, I got one last one for you. So a great point that my friend Todd Sohn, friend of the podcast and friend of ours, the point that he makes is he doesn't see, and I'll ask him, see if he still feels this way, but he doesn't see the end of this secular bull run in equities as an asset class without Europe ultimately breaking out. In other words, that European breakout from this multi-decade base, right? Because Euro 600 is still below the 2000 highs, right? We haven't broken out like the S&P 500 broke out in 2013. So his argument is that he finds it hard to believe that we're going to see an end to this before Europe has its breakout. Do you fall into that camp as well? How do you feel about that European underperformance?
I look at it, well, again, it's the absolute versus relative call here. It's rooting for Europe, but investing in the U.S. That, how bullish would that be? Imagine if the Europe was actually to finally get that breakout. That here's, speaking to the Europe 600, still below where it traded back in the year 2000, still, has not joined the secular breakout party. You can't, and this gets back into the inconsistencies that if you fall into these traps, if you key too much on valuations, that I have issues with this idea that the U.S. markets are overvalued. You got to get the heck out of there and go into Europe. It doesn't work like that. We ran the numbers, and Europe has only outperformed against a falling S&P 500 in 4% of all rolling 52-week periods.
Wow. Going back
to 1987. It's one or the other. That's the risk-on area, that if you do get that, if the valuation argument is right, that there is value in Europe and it does break above 20-year resistance, S&P 500 is going much higher. So I think that is the scenario where the secular bull market does have further to run. I'm rooting for that, but in the meantime, it's right now it's the higher growth in the S&P 500 that's getting rewarded, and where I want to be invested. And kind of said differently, if I'm wrong, when the macro sours, the weak get weaker. That we see that the greater downside risk in Europe rather than the U.S.
Ari, I as you're well aware, and I'm sure our audience can tell, we could literally do this all day. I could just keep firing things at you. I know you probably have a great answer for it, but for the sake of everyone's time, we'll let it go there. As always, I really do appreciate you being here. I enjoy our conversations constantly, whether it's on the podcast or over a beer in New York or whatever it is. So from the bottom of my heart and from everyone out there in the audience, thank you very much.
JC, thanks for having me on as always. Great luck to you. And we'll keep having me on. We'll talk markets every so often there. Love being on. Thank you very much.
All right. Look forward to it. Thanks, Ari.
Take care. Bye.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.